Welcome to Lighthouse Outlook, the podcast where we talk less about the markets and more about what matters to the people navigating them. From family offices to founders, we go beyond the numbers to unpack risk, legacy, and the human side of capital. Hosted by the team at McNichol & Associates Asset Management.
Good morning, everyone. Research meeting for August the 7th, and we're going to start off down in San Juan with an update out of Puerto Rico on Jurissa, and then just get into some of the residential sales stats for our telco company, Telmax. So just with Jurissa, so this is a litigation financing bank. And really the sort of main feature that separates it from a Lit 5 fund is the extent to which it can lend out. So it's more, 10-to-1 versus 1-to-1. The company received approval to get their banking license in November of last year, as indicated in this press release. That was actually quite a significant, milestone in the company's development, and it resulted in a fairly quick and immediate discussion with a credit fund out of New York called Cattler Capital Management, with a really strong track record in litigation finance. Now, Jurissa basically met with Cattler early in the new year, and after some discussions, executed a $20 million term sheet on April the 2nd, and the agreement included an exclusivity clause, which essentially prevented Jurissa from engaging with other alt investors during the due diligence period. The closest comps, by the way, from the public markets to what Jurissa will hopefully be are Burford Group, which is a public traded on the LSE in England, and Esquire Bank, which is listed on the NYSE. Those stocks. Well, let me just get to this before we talk about what happened. But essentially, Cattler advanced through due diligence discussions pretty quickly. They took a flight down to San Juan and met with legal counsel, as well as OCIF, which is the Puerto Rican version of OSFI. And the idea was to have a June closing transaction. What happened in the subsequent couple of weeks was that a U.S. senator by the name of Thom Tillis attempted to introduce a companion bill that would have been sort of glued to the Trump Big Beautiful bill, and essentially it was tackling predatory financing, and it was called the Tackling Predatory Litigation Funding Act. It was, a procedural move that really allowed him to bypass the filibuster. And so once that news broke, shares in Burford Capital and Esquire sold off a little bit. I actually read the bill. I remember reading the bill on my front porch in detail, and there was some language in there that on the one hand was a little bit outrageous, but on the other hand there was a lot of qualifiers. Like they used terms like qualifying legal transaction. What do I mean by that? You can't really sue somebody because they don't like your shirt and tie combination. I mean, that's just ridiculous. And so the real wording there was qualified transaction. But anyways, later that same day, Cattler notified Jurissa that in light of this call it regulatory or legislative risk, they're going to take a pause on advancing the monies. Here's where the Senate parliamentarian kicked in. So the lady on the far left, I believe her name is Elizabeth McDonough, and she's the Senate parliamentarian for the United States. She ruled that the Tillis provisions of the Tillis bill are inadmissible under U.S. reconciliation rules, and even though the Big Beautiful Bill was signed into law on the 4th of July, it did not include the Tillis bill. And so very shortly thereafter, Cattler came back and said they are prepared to proceed with their investment. However, now they require some contingencies in the context of a $20 million senior debt to sort of match their equity raise. I've been in touch with the company several times. It really doesn't appear that at this point this is a major problem. But the risk and the reason why a lot of these investors are maybe let's say call it concerned-ish is that Tillis may try this again in the future, that sort of thing. Ultimately, I don't think it should be an issue provided they can find the 20 million, which it sounds like they will. But the issue here is again, you can't really sue somebody for what amounts to inappropriate reasons or anything like that because it would get tossed out by the judge. And so yeah, this story is sort of ongoing. There's a few other additional developments. So the government of Puerto Rico did officially decree that uh, the company has that tax exempt status. So that's obviously a positive. And they have engaged the Castle Placement and Broker Dealer Support Agency to raise the 20 million. Joe Tosick, who was previously on the board, is no longer on the board, and there was a vote on July 30th to replace him with Mary Mar Perez Riera, who has a really good background in this area. So that's an update on LitFi. Telmax started reporting a lot more quickly, so we're getting monthly and weekly updates from the company, which I think is good. And we're certainly not going to talk about Telmax every week on these meetings because not a lot will change. But just taking a look at some of the residential sales volumes for the weekend of July 27th, they continued to trend above target, which is good. And, total sales were slightly higher for that week. I'm not really an expert on telecommunication companies. In my neighborhood, I haven't seen, the Rogers or BCE people for several weeks. So I don't know um, if they sort of take a break over the summer because they reckon that everybody's up at the cottage or something like that. But the company, had a good week. The momentum is also due to the fact that they brought in some third-party sales reps, and this was something we talked about at the Telmax AGM last year. We kind of concluded the investors concluded that you guys definitely have something here. You just got to go out and kind of bulk up your sales a bit more, which it sounds like they're doing. The direct sales channel continues to focus mainly on Newmarket and Stouffville, and that's positive. Overall, gross sales were kind of in line with the prior week, about 176 new accounts, and direct sales slightly lower compared to the previous week. So very short term kind of comp window here. Inside sales were quite a bit higher, and so that's good. And they also have really amped up their website. It always looked okay, but it's certainly now a lot more. I guess current is the word. Like it really is looking like a high tech telco company, which it is. And then the web and promo landing page traffic down versus the prior week, but again, that could be the long weekend, late July into August, that sort of thing. So we'll see how that goes. Um, just a few more updates here on residential sales. Inbound calls to the sales team were up, and so that was 140 versus about 130 in the prior week. 40% of the calls were sales inquiries, so that's a positive. I think you're starting to have a little fatigue with regards to the incumbents. And, the whole sort of thing around Telmax was to essentially become sort of a big enough headache for a lot of these big players that, maybe they get taken out, or maybe guys like Omers or something like that step in and purchase them. But yeah, I mean, the idea here is that they are kind of rolling out a lot of these current offers. Yeah, the month to date sales mix remains sort of broadly in line with plan. 43% of the sales are actually coming from Newmarket, 29% from Stouffville, and 24% from Aurora, which which kind of makes sense, just sort of given the population of these respective cities. I think with Richmond Hill, it'd be really great if that area started participating more. I used to spend a lot of time up in Richmond Hill, so um, I think that, with Telmax, my hunch is that they'll probably do better in sort of areas outside of major urban metros, but we shall see. And the month to date new family home sales mix this week was 3%, with the majority of those sales coming from these remarket fiberhoods. So I think that's a pretty good breakdown. Again, we're not going to talk about Telmax every week, but we are, a shareholder here, and the exit potential here is quite big. So I do want to keep everybody aware of it. As far as order slippage goes, um, it was quite low. So they lost 3 accounts versus 20 in the prior week, and the month to date slippage rate, is trending below 5%, which is sort of their target. In other words, they're gaining more clients than they're losing, and this is sort of the revolving door of being a essentially a retail phone and internet provider. Disconnects were up only slightly. Um, but that disconnection, I think, has to be thought about in the context of people moving. So remember, they're basically, the way this got started was the CRTC gave them an express regulatory approval to increase competition in the fiber optic telco space, and then they started feeding fiber optic cable through a lot of these sonotubes under the ground into people's homes. And so these disconnects are not people saying, "Well, I'm going back to Rogers." They're really just more driven by people moving. So that's sort of the issue there. And then Power Sustainable invested 110 million bucks in the expansion. So Power's sustainable investment division is now a major player here alongside of us. And I think the way to think about this is Telmax is ultimately, I don't know if it's right to think about this as a utility. It's really a telco, but it's essentially like a high performance version of what you would get with Rogers or the incumbents. And so I think a lot of these sustainable big infrastructure investors are now starting to say, okay, I think they're onto something here, and we're going to give them some money to sort of help stuff move along. Okay, charts of the week. So I think, not really sure where Andrew was going with the first couple of pages of his essay. It was great, but I think he was really more fixated with this 6100 level. In fact, let's get into the charts right away. What he's saying here is that the market has been sort of in this first to second standard deviation range of its 50-day moving average. So to kind of generalize, the market's been, mostly overbought for the last, since May, and these dips below that 50-day moving average line have been very, very short term. And it appears as though last Friday's dip is proving out to be the same. So you saw right up here at the top right-hand corner, a dip through the 50-day, and then looks like it's starting to come back. So he's taking the stance of, unless there's further information that gets communicated by market-based indicators, these dips are likely to be minor and short-term in nature. And so here you can see, now this is his own sort of RORO, just as a reminder, is his own personal risk on, risk off model. And so right now, what you can see is that as at the end of this Monday, the market is sort of, you can call it not mixed, but just starting to return to the very early portion of, let's say, becoming strong. If you sort of extrapolate the rebound off of the sell-off. Overall markets, look interesting as always. Um, I think the one that's interesting, really, just to me personally, is gold. It's done a whole lot of nothing for, a couple of months here. Of course, that's after having a very very good move, and so maybe a period of consolidation for AU. So that's great. We did get just a little bump up in volatility down below. Maybe that's a good thing because it indicates people are at their desks. And then I think with the rest of these numbers, we'll want to keep an eye on that semiconductor versus S&P 500 chart because it looks like it kind of, peaked out and then rolled over, and now maybe it's sort of starting to enter a consolidation period. I don't really know if that will continue, but looking across the sectors, really the major mover relative to last week is going to be that five spot move on the part of utilities. So that's that. This is the S&P 500 cap weighted index from kind of a longer angle view. And from a longer term perspective, he's quite bullish on the stock. So if you go back very very long term, it didn't get captured in this chart, but in the write up, he went back like I think 100 years, and he notes that the market is up against this very very long term upper limitation line, and if you breach that in any sort of sustainable way, he does mention that there is a very real likelihood that stocks kind of take off and head higher, but at this point it is too early to make that determination. So he just kind of points that out, and then here you have these various support resistance zones along with the slower and faster moving averages. He points in his writing here. He says, "I'd be surprised if we fall below here," and that just sort of gets back to some of the other technical data points in the previous slides. So it should be sort of relatively smooth sailing for the rest of the summer. But again, the question you have to ask yourself is, I kind of grew up thinking about volume and activity as sort of the degree of conviction that investors have, and I just haven't had a chance to take a look at overall trading volumes across the indices. If you do get, a correction, what he's indicated here is the percentages and the lines of how far, for example, 10% correction takes you. So it takes you down to in that 50 some odd 100 point range. Again, these 10, 15, and 25% declines in his mind currently are unlikely. But it's good to kind of have these stop losses kind of written down. This is the equal weighted version of the S&P 500. It really doesn't have the same sort of oomph or pizzazz that the cap weighted version of the same index has. So you always want to be mindful of the fact that if your investors are looking at the S&P 500, really they're only looking at sort of a fairly narrow sliver of the market, albeit one that's ginormous in cap weighted terms. But sometimes it's effective to superimpose the cap weighted index over the equal weighted index, and you could see here, kind of topped out again and not doing that much. XU versus the SPY. I think what you're seeing here is a little bit of a breakout in this sector. I don't know if that's really just sort of uh, a desire to have yield as interest rates appear to be going down. I think both. I'm not the bond guy here, but I think short-term rates and long-term rates have kind of gone down. So maybe people looking at some beefier yields there in utilities land. And here it is, the SOX semiconductor index. It seems like it'll be caught by that green bar, that support zone, and then hopefully head higher. The idea with semiconductors is you want them kind of leading the market forward. So that's interesting. And finishing off with USD. So this is a US dollar index. This is not CAD USD. It's kind of hard to get a gauge on the US dollar just looking at it. I think the beauty in trying to guesstimate what the US dollar will do. You really got to look to treasury yields and kind of see what they're doing. I think is the best advice that I would give in terms of trying to figure out the US dollar here. And that's all I got today.
Thanks, Joe. Ken?
Uh, August 7th, same disclaimer Joe showed at the front end. Just contact us through email or even phone or visit our website if you have any more questions. I'll just be pretty quick here. Not a lot of changes. S&P 500, kind of a rocky last week or so, obviously on some trade news or lack thereof trade news. Continues to be led by that mega cap area, that magnificent seven. It's up about 8% year to date. You can see that little pullback on this chart. That was more from last week. Kind of has rebounded this week, but I was off last week. Monthly momentum finally turned over after a 10-month streak of negative momentum. That's a positive sign there. And then overbought, oversold. Looking at demand there, it's the second lowest over the last 6 weeks, so a bit of a pullback. And last week was the lowest, so we'll have to see. I mean, I had mentioned before that the rate of overbought for the S&P, even the NASDAQ and some other indices was kind of unsustainable midterm just because of how heavily it was being overbought by investors, and that's a lot of retail investors, obviously. So we'll have to see if that continues or we get a lack of demand and how that impacts overall indices. Looking here at the NASDAQ, similar move to the S&P. Bit of a pullback there. Support's now $10 is lower. It flipped over last month in July in terms of its monthly momentum. The NASDAQ 100's up about 10% year to date. However, it's up over 30% since those tariff bottoms in April. So, I mean, for those that have missed this kind of massive rebound, perhaps now not is the time to go all in on high risk assets. We overbought, oversold 69%. That's the second lowest since June 27th. Last week was the lowest on its small pullback. So kind of same thing as the S&P. Obviously, you got the AI investment from companies continuing. Apple with a big announcement at the close yesterday, sending its shares up during the day yesterday about 5%. But it seems like there's some cracks in the industry. Data center numbers kind of worried investors. Even though they beat earnings, they kind of beat earnings on historic business units, if that makes sense, like classic GPUs and not the AI high-tech ones that many investors were focused on. So kind of an asterisk on their earnings. So we'll have to see if that continues with certain companies in the artificial intelligence space. Flipping here, this is just the Dow Jones. $3 decrease week over week, but it's been two column changes. It created this buy signal, reaching this resistance line that it had got to in January and December of last year, before reversing last week and creating its first sell signal since May. So something to note there. Short-term support is $4 lower, which is a positive sign. Did reverse its monthly momentum after 7 negative months, and then the price objective decreased. So compared to the other indices, the price objective actually changed on the Dow. So you can kind of see the cracks in the foundation for we'll say this value index compared to the growth ones, with some of the data points, especially the overbought, oversold all the way down at 29%. That's an increase week over week, but that's one of the lowest in the past 3 months. So something to watch really closely there. Looking here at the TSX 60, two column changes, $3 increase over the last 2 weeks, creating this buy signal here. And it also created some short-term support, only $6 is lower. So the setup for the Canadian equity market continues to improve. There's continues to be inflows north of the border, reflected here in the overbought, oversold, 119% this past week. That's the highest since 2017. So that's not nothing, but it's important to look at. Obviously, the tariff rate for Canada is going to be increasing soon. After Trump made an announcement hiking the tariff rate for us, there's also been no deal. We're one of a few larger trading partners of the U.S. that has no deal. I think those include India, obviously China, they continue to work with, and then a number of other countries in Asia and even Australia, still no trade deal. VIX, volatile 2 weeks, one new sell signal followed by a buy signal earlier this week. Obviously, we got some headline items that are impacting markets right now, tariffs, earnings, and the Fed. Trump's kind of taking his foot off the gas with the Powell, Fed, all that stuff. But I think Trump is naming a new Fed governor, or excuse me, a new Fed board member. I think sometime this week or maybe early next week. I forget now. But important there. Target increased to 35%, so implying a more volatile forward look from a technical basis, at least. Just looking at these bullish percentage charts, both pulled back here to multi-month lows, actually. The NYSE back to a June low, and then here S&P 500. This is the lowest going back to April, so a pretty swift pullback over the last month for the S&P, showing that it's, even though it continues to perform well and we haven't seen a 5% or something pullback, it's really top heavy right now, and it's the largest components that are pulling it along, like we've seen over the last few years at times. Percent positive trends. NASDAQ pulled back a little here, still remains above a bullish territory line. And then the Dow Jones, 82%, still has not reversed. Watching those two charts closely. Toronto Stock Exchange, both of these still in X columns, moving higher. We'll have to watch if they do pull back in the coming weeks. Not a lot of changes here. Tech, actually, interesting enough, lost 5 buy signals over the last 2 weeks, flipping positions with industrials. Real estate's actually gained a couple buy signals over the last 3 weeks. It formerly was in the second last position. Obviously, Joe mentioned some relief in terms of interest rates. I'll show a couple slides in a bit to kind of look at that there. And then the Latin American region had picked up 5 buy signals over the last few weeks. So something to note there with a bit of a pullback in the overall Latin American region this year. We own only Mexico within that region. Excuse me, the iShares Mexico. It's performed really well. It's not the reason that on a relative strength basis is lower within the international equities. I think it's up about 28% year to date, and like 12.5 or so over the last year. So even with that pullback, really looking strong there. I think this is being pulled back mainly due to, I think, Brazil and a few of the other smaller South American countries. Looking at the next slide, this is just the iShares Canadian Tech Sector Index Fund. We own this in our relative strength program for our smaller clients. It was up about 6% yesterday. It's up 16% year to date. Price target's about 116, and it's trading in the low 80s right now. So you can see some upside there. And the fund scores are basically a 5.92 out of 6. The reason it was up about 5% here yesterday, was Shopify's earnings, which I had a quick glance over yesterday afternoon. Didn't get into them really heavily just because I was doing this and writing the commentary, but a huge earnings beat. They revised their forecast, sending the stock up 20+% yesterday. Shopify is one of the larger components within that tech index. Continue to have a great blend of value and growth in our relative strength platform. Just this quick slide, obviously, we know who the two people on the right are at their recent press conference. On the left, just looking at the target rate probabilities for the September 17th Fed meeting. That's about 5 weeks away. About 93% chance now that the Fed cuts rates by 25 basis points. So really seen a complete pivot in these probabilities over the last month and a half or so. I remember at the start of the year, many were forecasting that September would be the first cut, and then it kind of pushed back a little, and then it was about 50-50 about a month and a half ago on this chart in terms of would we get a rate cut or would we not. And now obviously it almost seems certain that the US will see its first rate cut in, I think, I don't think they've had a rate cut this year yet, in over 9 months. Now you can see this is the 30-year mortgage rate. I mentioned that real estate kind of perked up recently in terms of the equity markets, in terms of the rankings. Mortgage rates are at their lowest level in 4 months, dating back to April. You can see here, I mean, it's a little blurry, but basically 7%. All the way up here, 7.5% at that peak that we saw in May. Perhaps some forward looking from consumers, especially with the last chart I showed that talks about the rate cut probabilities for September. Just looking here, this is Dorsey Wright's monthly look at volatility. They just talk about how, despite it feeling like a very, very volatile year, it's historically been average so far. These are the annual percentage of 1% daily moves as a percentage of the overall days within a year. Right now sitting at 28%, which would be the highest since 2022. But the average dating back to 87 has only been about 26.7%. So basically average. This is an interesting chart that I found. It's basically tracking the New York Times stock price dating back to 2015. I actually forgot the New York Times was a public company, but you can see the majority of the gains have actually been during when Trump has either been elected or the actual president. I think they wrote up about 90, it was something in between 90 and 95% of the gains over the last decade plus have been from Trump being elected or Trump being in office. Really, during the Biden period, you can see basically a flat line there overall for the New York Times stock. Obviously, consumers continuing to buy fear and some angst. Just an interesting chart that I found. Looking at this here, the healthcare S&P 500 weight as a percentage sitting at the lowest in more than 20 years. You can see that basically back to 2000, 2001, it was at this percentage. It's looking like it might break below this kind of line, which would push it closer to a 30-year low. I mean, if you're a bit of a contrarian, I'm looking for some value. Some of these healthcare stocks really looking interesting right now, especially with the environment we're in, where everything's trading very expensively and is more high risk. You could buy some defensive names that are closer to 52-week lows and 52-week highs, and perhaps get a strong bounce moving forward. And this is just the healthcare ETF by Spider XLV. Fund score doesn't score very well. It's year to date down 1%. You can see it's at support right now at 130, so a nice sign there. But it's basically been consolidating since 2021. Would need a real breakout here. And then the average PE ratio below 17, more attractive than the S&P, obviously. Obviously a little less growth, but nonetheless, just an interesting contrarian trade for the time we're in. And that's it for me.
Good one, Ken. We'll have to put a notice on the healthcare one to see when it does start trending up. Then we should take a closer look to dip our toe in. I'll start off with the morning coffee, and then I'll go to a gold report that came in that I thought had some interesting charts. So we've heard lots about Trump and Apple and all that. And the latest news item this morning I see on Bloomberg is he's going after the Intel CEO. So guy's relentless. Yeah, nothing there in company news I want to get into. Tourmaline looks like they've got some more insider buying. It's trended down. That energy number that Ken showed and that analyst showed from Dorsey Wright are very important. I think, Ken, we're going to have to take a close look at our energy positions. If it breaks down further, then I think we're going to have to get out of the way. The breadth is definitely to the 52-week highs. 52-week lows are a bunch of small names, so those are gone. The US, it's a little bit more balance. But yeah, the usual suspects on the 52-week high, especially with the on the gold side. And now this is the TSX has been on fire this week. And I saw like the other day it was up 2%. So the weekly's 2%, the monthly's over 3. So it's doing very well. The venture exchange even better. Venture exchange is up significantly. Joe, we should talk because our I won't say his name here, but our venture manager is not keeping up with this at all after, some terrible results in the past.
Yeah.
Should talk about that. And what else can we garner from this? France is a little bit on the red, as is India. But every country and major market is green for the year. If we go and look at the commodities, we pretty much beat this over the head. But yeah, crude is breaking down, as is nat gas. Precious metals are all strong. Looks like silver is getting a little bit more support. Copper's down tremendously with those tariffs that are being slapped on it. So that's going to put it in the doghouse for a bit. I'll show the Canada US dollar on the Dorsey right later. And I'll also do some interest rate work, and Chris Curry can chime in after that. And on the headlines, I didn't see anything new of well, it's all new headlines, of course, but I didn't see anything of value there. Helps. This gentleman named Jim Hunter's been talking for years and years, and I thought this was a very interesting chart. Let's see if we're on the bottom here. No, we need to see all this too. So the dark line is the 1970s, the light line is the 2000s, and I guess you want to call it the light green line is the 2020s or right now. So there we are in the 2020s, 2025 there. We've had this tremendous run, somewhere in between the 70s and that. And look what you have to look forward to for the next second half, as they call it. Anywhere from 150 to 162% up from here. That'll take you to 520 weeks out. Yeah, so that'd be a year. No, that'd be 10 years. That's a big long run there. And then the final leg, yeah, that's still quite a ways out. So yeah, so we've got another long run here on what Alps seems to think. Yeah, I think I'll just probably leave it to that one. Yeah, this is getting a little bit frightening that it could get to the point that all tax revenues go to interest costs. This is why when Trump doesn't want the Fed to just lower rates, I've seen a report that he wants them to drop rates by 3%, 300 basis points. And now maybe that was a bad errant piece of research, but that's just lunacy that he thinks that the market can cooperate with that. It'll just be mayhem if that ever came close to happening. I think the biggest drop, Chris Curry, correct me if I'm wrong, is like 75 basis points in one cut. So nothing close to 300. Yeah. So anyways, you can take a look at this report on your own, but there's some other good charts that you might want to grab for any of the commentaries, etc. PE, cap ratios, gold reserves, M2. Yeah, that's a similar story there as the first chart. Just the M2 growth has been significant for the first half of this period. This is in months now. And the second half, you're going to see some more M2 growth. Yeah, sort of repeating himself with more gold reserve stuff. Yeah, let me know if you want to see more of that. Let me finish up with the playbook from Dorsey Wright. So yeah, the Canadian dollar, 73 cents. It got up to 74 there. The targets are still the same, 80 cents for the short term and 62 cents for the long term. So we haven't really seen a major breakout yet. And with the US dollar ICE spot index getting weaker and weaker, that's what's was putting this upward pressure back in June. on this. That's June 1st there. But since the summer, it's rolled down. So actually, we never really saw 74 cents. I thought I did see that on someone's thing, but anyways, it's trending down. We're at 73 now. Got down to 72.07. So I think you can just see some sideways action like you exhibited in 23 and so forth. We'll just watch that, but not much we can do with our privates, unfortunately. Oh, there's a new thing. I can scroll down. I didn't know that. Yeah, so there's the US dollar spot index at 98. It was trending. Well, I'll show you again on the charts. It's trending down, but it's got an upside target of, what was that? 103, I think I saw. They're not showing it here. But the overall trend has been down, as I've saying, since the beginning of the year from 110, bottomed out at 96.50. But the trend still is down at 98.18. I like that. I don't have to scroll anymore. Crude, we've talked about 64 down to 57. So maybe time to let off some of those positions just to let this bottom out. Yeah, because even the producers measure down. Copper measures way down. As does uranium. That's a change. I haven't noticed that. So that directional movement for uranium is changed. Gold measures down a little bit. Probably long overdue after having almost a 30% gain in the year to date. The producers are up there, as are the VENEC majors and the VENEC juniors. Silver itself, futures measure up considerably, but the producers are down. So maybe they've already had a bit of a run getting ahead of themselves there. Platinum, Mark Faber, I've been reading Faber, been reading him recently, and he feels that platinum is the most valuable of all the precious metals. But it looks like it's trending down. And look at that, 48% year to date. So he's been right for this year. Bitcoin up to 208,000, Ethereum to 7,300, and then the crypto exchange looks like it's flat there. Finally, on interest rates, so the 2-year has come off a bit, but it still measures down to 275. 5-year measures down, 10-year, and the 30-year measures up. So that's nothing's changed there, just the steepening of the yield curve. And that is it for now. Ross, I see you're there. Do you want to update us?
Sure. Yep. Go ahead. First off, the Standard & Poor's 500, a little bit of setback, although I guess it's been a little bit firm very recently. Today, the S&P stands at 63.45, and that target price there, which is what we call the LSG price, 4.5 times book, is 64.83. So that's our that would be our maximum target, I think, for the S&P, unless the S&P can actually break out. And in order to break out, we're going to have two things: a very strong economy, and we're also going to have rising return on equity. I think rising profitability. Now, those people who are touting the effects of artificial intelligence, AI, say, well, sure, that's coming. But Fred Hickey says, "Show me the money, honey." He hasn't seen the actual numbers proving that AI is actually doing something for companies, as opposed to doing something for the chip makers. Anyway, that's the S&P. The next chart is the Standard & Poor's 500. That also is moving up to this 9.5 times book value, the HB1 price target. That right as of today is 24,250, and we are at 20,315. So it's got about 1,000 points to go. There, not about 900 points to go for the Nasdaq. So we don't necessarily have to see that the Nasdaq is necessarily going to quit, and maybe it'll get back up again to its peak as well. And the last index I want to show is the Standard & Poor's, is the TSX Composite. And I pointed out for a long time that the fair market value of the TSX is actually considerably above the current price of the index as compared to the Nasdaq and the S&P, where the fair market value is below, and the Nasdaq a lot below the current price, which has led us therefore to be more bullish on the TSX. It also, of course, is only here about 1.7 times book value, whereas the Nasdaq is almost at 9.5, and the Standard and Poor's is almost at 4.5. So the values, I think, are very clearly in the TSX. Okay, this is gold seasonality, and it's really quite interesting how gold this year has conformed almost perfectly to its average seasonality pattern. We had a very strong beginning of the year, and the gold stocks have done very well. Lately, the index has been sort of moving sideways, but as you get into August, here you see the index breaking out and heading higher. That appears to be very much the case. The leveraged gold index, the nugget, has just exploded upwards, and most of the stocks are doing very, very well. I have said before that just wait. The Americans are not here yet. They're probably messing around in cryptos, which are fundamentally nothing but a big Ponzi scheme with nothing underneath them. When they switch to gold and gold stocks, watch out. Historically, then you can get some really, really big moves. So we remain very positive on gold, and our suspicion is that God willing, and the creek don't rise, it could go a lot higher. And if Trump keeps doing some of the incredibly stupid things that he's doing, including the big beautiful tax catastrophe, then yeah, we are definitely heading higher. I want to point out one interesting thing, and that is to say that the last time a sitting president attacked the chairman of the Federal Reserve Board was in the days of Lyndon Baines Johnson and Nixon, and it's rumored that. The story goes that LBJ invited Arthur Burns to his ranch and apparently slammed him up against the wall and said, "Get those rates down." Well, that may be as it is, but what was the omen of that? Yeah, I think Arthur Burns kind of did knuckle under a little bit, but the outcome was pretty much as we expect today. The outcome, this was in the early 70s, was exploding inflation and much higher interest rates there. Quite frankly, looking at the fiscal condition of the United States, we can see something very similar to that happening as well. Whether Jerome Powell will knuckle under or not kind of remains to be seen. It'll be really interesting to see if he does not knuckle under, because he is going to face pressure like, I guess Trump could invite him down to Mar-a-Lago and slam him up against the wall there. That would be an interesting event to occur, but we would have to say that the pressure on the Fed is to move rates, in our estimation, probably the wrong way. Anyway, that's all that I have to say today.
Okay. Chris Curry, do you have any updates?
I think this meeting is probably one that'll be notable for the most talk about interest rates in the bond market and in a long time. But I think that all relates to last Friday's news of the miss on the jobs number, and then the massive revision in the past 2 months of May and June, and then the subsequent firing by Trump of the head of the Bureau of Labor Statistics. On that day, the 2-year bond dropped 20 basis points. And that's created a huge gap between Fed funds, which are at 4.25 to 5, with the 2-year now 3.70. There's, excuse me, 50 to 75 basis points of where the market is saying the Fed fund should be, and that's driving some calls out there for a 50 basis point rate cut. Ken very astutely pointed out the CME forecasting tool that shot up from a 60% probability of a 25 basis point rate cut at the September meeting to now over 90%. And if you click further on the CME tool, they have a cut pretty much at every meeting. There's 3 more meetings to go. Interestingly, in Canada, because of inflation ticking up in Canada, similar market-based forecasts are showing no further cuts in rates in Canada. So that could help the Canadian dollar. There's no Fed meeting in August, but instead central bankers and CEOs meet at the famous Jackson Hole conference, which this year takes place from August 21st to the 23rd. So I would expect a lot of political posturing there by Fed governors who are auditioning for the Fed chair job, and I think the leading candidate's probably Christopher Waller. So I think we'll CNBC does a pretty good job with interviews down there, and hopefully we'll see Jamie Dimon and other large CEOs of the bank speaking on the current outlook. So on that point, Dave, I'd like to wrap up there.
Okay, Chris, thanks for that. Anybody have anything else before we say goodbye?
Yeah, we have the new largest market cap company in Canada. You might have heard of it before. It's called Shopify. And, it's really leapfrogged over Royal, TD, and Enbridge, $276 billion in market cap. And it looks like it could go even higher. I mean, they had pretty good results. It doesn't appear as though, Trump is really factoring into their operations. And the CFO actually gave pretty rosy guidance. So I guess times they are a-changing.
Yes, indeed. Okay. Well, I guess Paul Beatty's away on vacation. I tried to get Sean Cumby to join us just to get an update macro on his world, but he's been held up in a meeting, so we'll get him next week. Okay, bye for now. Thanks for listening to Lighthouse Outlook. If this conversation sparked a new perspective, share it with someone who thinks differently. Subscribe for fresh episodes every 2 weeks and visit mcnichollasset.com to learn more.